Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be discussing 4 steps to building a powerful portfolio, the All Ordinaries Index, and then I'm going to be looking at the materials sector. Now before we jump into the report, I'd just like to mention if you have any thoughts on investing, please comment below and subscribe to our channel to keep up to date with our new content. So let's get into the report. Now, whilst you may think that being successful in the market is about buying and selling, I propose to you that portfolio construction is just as important. So much so that poor portfolio construction will reduce your portfolio returns. There are a number of factors that will affect the way you construct your portfolio. All successful traders have a strong plan for managing portfolios, and so should you. Today I'm going to be sharing with you 4 steps which will help you to construct a powerful portfolio. So whether you're a beginner or an experienced trader, the fundamentals don't change, and having a plan to manage and grow your portfolio will ensure you reap the rewards. The first step to building a powerful portfolio is to understand your why. You see, your why is a major contributor to understanding what you want to achieve from your portfolio. Whether it's generating supplementary income, growing your capital for retirement, or some other reason. Finding your why gives you clarity when it comes to constructing your portfolio. The second thing is active or passive investing. Whether you're trading for short, medium or long term, there is a style of investing that will suit you. Understanding your why helps you decide whether you want to be an active or passive investor. If you're trading to generate more capital come retirement, a passive approach to investing may suit you better. Alternatively, if you're trading for cash flow, you may wish to take a more active approach. Either way, the choice is yours to make. Your choice will also depend on the amount of time that you have to put in. One thing I constantly preach is that trading should be to generate a lifestyle, not make it your lifestyle. The third point I want to bring up is diversification versus diversification. Now this is a concept I introduced in my first book. Portfolio diversification is critical when it comes to building a powerful portfolio. You do not want to have all of your money caught up in one investment, otherwise you become exposed to specific risk. Now specific risk is a direct exposure to the threat of a company collapsing. What you want to do is diversify your portfolio by investing in multiple companies across different sectors and markets so that you're not overexposed to specific risks. Now this raises a question, how many different positions should I have? Now I recommend having between 8 and 12 positions in a portfolio. Any more than 8 to 12 positions puts you into a situation that I call diversification. Now diversification occurs when you have too many positions, and the effect of that on your portfolio is that it erodes your portfolio return. This is the most common thing I find wrong with portfolios. Now this brings us to number 4, which is risk management. Managing risk is the most important factor for building any portfolio. Having a set strategy in place to manage your risk is critical for your long-term success. Now all good traders have a plan to manage risk. On average, 80% of traders lose money investing, 10% break even, and 10% are profitable. This is alarming because it identifies those who do not plan to manage their risk. Now there's a golden rule that says cut your losses short and let your profits run. To easily manage your risk, you should use a stop loss. Now a stop loss is essentially saying if a share falls below X price, I will sell it. Now I recommend setting a stop loss at either 10 to 15% of your initial investment. Successful trading does not come from how much money you make, it's about how much money you do not lose. These 4 simple steps are outlined in my book, Accelerate Your Wealth, and armed with them you can easily manage your own powerful portfolio. If you would like more, you can also purchase a video of a presentation I did called How to Build a Powerful Portfolio from our website, wealthwithin.com.au. So what do we expect in the market? Well, this week the All Ordinaries Index traded to around 6,200 points, which is very important. The broader market index has gained more than half of what it lost when it fell from the high of 6,256 points in January to the low of 5,834 points in April. The All Ordinaries Index traded higher last week for a fourth consecutive week. This move reduces the risk of a fall below 5,850 points. That said, I would like to see the market pull back for 1 or 2 weeks towards the end of May or early June to test support before it continues to rise. A continuation of the current rise without testing the levels below it may indicate more significant peaks lie ahead. Okay, on the screen now you can see a weekly chart of the All Ordinaries Index, and as you can see here, that low that I mentioned on the week ending the 6th of April was 5834. The previous high that I'd also mentioned in the report from the week ending the 12th of January was 6256. So that fall of roughly about 11 or 12 weeks there has been recovered over the past 4 weeks. So what we're seeing now is prices moving a lot faster than what it was the prior 3 to 4 months here. And so we see 1, 2, 3, 4 bars moving up. Now, whilst the high of last week, which is the week ending the 4th of May, was around 6199 points and it closed at 6155 points, it did come off at the end. It still was a very, very strong bar. As you can see here, the range was 162.9 points for that 5-day period. So it's quite a phenomenal rise in the All Ordinaries Index. So what I'm suggesting now is we probably in the next 1 or 2 weeks we'll start to see a 1 or 2 weeks down. I would like to only see 1 or 2 weeks down, not longer than that, before it starts to rise up again. If it does start to rise up again after that 1 or 2 weeks down, then we know that this low here back in April, on the week ending the 6th of April, is actually the low on our market that we have expected, and that this high of 6256 will be broken. And then we can also go back and look at more of the history. If we keep dragging back here, we can see how the All Ordinaries Index is now getting to closer up to its previous all-time high way back in 2007. So that would be in danger of being broken. So let's now get into the material sector. What I want to show you is stocks like BHP, Rio and Fortescue, because these stocks are pretty much the sector, obviously the material sector. Obviously BHP and Rio are the two big ones, and this sector has been looking exciting and it still continues to look exciting. After last week's report where I said none of the banks are looking exciting, and I don't think they will be very much for quite a while, and we're seeing the All Ordinaries Index being very, very strong while the banking sector has been quite weak. Now, I know there's a lot of reports out there, people are saying don't sell the banks, don't desert them just because of the Royal Commission, but geez, if they're not going up, get out of them and get into something that is going up. People sometimes will hang on to stocks like the banks just for the dividend yield, but if you're losing 10, 20, 30% in a year just to get a 4, 5, 6% dividend, it's not smart investing. You're better off in something like a BHP or a Rio that is moving up, and as you can see how strong these are. Their lows there back in January 2016. You can see how strong this move up is here on that monthly chart for BHP. I think there's a lot more to go. I think BHP is heading past this $36 mark, and it probably will give this $45 mark a good shove over the next 6 to 12 months here. So it's looking pretty good. Let's move on a little bit further and we'll go and look at Rio. Rio's in a similar boat. It's a little bit more volatile than BHP. You can see here on the left hand side on that monthly chart, it did have a low there back in February 2016. I think it's going to head through, let me just expand this up so you can see it. I think it's going to head through this previous peak at 82.73. It'll keep rising, and I think it'll go through that prior high from February 2011 at $89. I think it's going to continue to move up. I don't know whether it'll, in this run, it'll go through that previous all-time high at that $124, but you know, these sorts of stocks do run pretty hard when they do run. Lastly, I'm going to talk about Fortescue. This one has been a little bit more harder hit than those other two. It's sort of like had a lot of challenges since the GFC, and you can see here this big sideways movement there. It did hit a high in January 2011 at $7.34. It did try and push through that in February 2017 where it hit 727. It couldn't break through it at that time. It did fall away heavily down into that low in January 2016, like BHP and Rio, but then it moved up to that high there that we saw just a second ago in February 2017, and then it's fallen away strongly down into a low in last month of $4.18. I think this has got a lot more to move. It will try and play catch up with those others, so there might be more opportunity in Fortescue. But we still haven't confirmed that low there in April is the low. If you go back and we put that onto a weekly chart, you'll see what I mean here. Is we still need to confirm that that's the low in here. It is looking all right, but I would probably like to see it get through this sort of $5.40 mark before I get super excited on it. But this is a sector that is looking good at this point in time. So that's it for this week on the chart. For the next week, good luck, good trading. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.